Hello. In today's video of things that are important but incredibly underappreciated, we're going to talk about the topic du jour, which is the fact that today is Fed Day. The Federal Reserve is meeting and they're going to announce their policy in their decision. There will be a dot plot. Chairman Powell will have a post-meeting press conference with the press. And if you've been watching CNBC or reading the Wall Street Journal, a lot of the pundits are not focusing so much on the Fed raising rates, but have been talking a lot about when the Fed will start cutting rates. You've probably heard some pundits say that they expect the Fed to start cutting rates and becoming more dovish, a less restrictive interest rate policy in like June of 2024. But before we get into thinking about when the Fed is going to be dovish, we have to think about where the Fed is right now and why they may come across more hawkish than the market expects. And so a nice starting point is to think about financial models. Canonical financial models say like your capital asset pricing model, which goes back to the 1960s with work by Bill Sharp. Now, the capital asset pricing model is a model to understand risk and return. Stocks with more exposure to the market should earn higher expected returns, all else equal. Okay, so it's a nice framework to think about things like a risk-return trade-off. That said, all models are wrong. Some models are useful. And so when we think about the backbone of things like the capital asset pricing model, there's some very generous assumptions like all investors have the same information, markets internalize new stories and new developments instantly into prices. So markets are hyper rational and super efficient. Investors are unrestricted in what they can buy, how much they can borrow. And you have these very generous assumptions that gives us a nice benchmark, a nice framework to start thinking about risk return trade-off. That said, markets are far more complex, and there's all sorts of tensions and frictions and behavioral biases that in the real world don't match the model. And so if we just take a step back thinking about the complexity that the Fed has, is right now they have to buffer against consumers and firms thinking that inflation is going to be tamed or thinking that interest rates are going to come down. Because if you're not careful, things can be a self-fulfilling prophecy. So if everyone thinks interest rates are going to come down, we're going to have a much less restrictive monetary policy, say, next year. Okay, folks are going to start internalizing that today in their decision making and might start, doing things like raising prices in anticipation of there being just a massive spike in growth next year. And so the Fed has to be really careful with that. They cannot let inflation be a self-fulfilling prophecy. And so even though they might think internally, hey, we're probably going to be cutting rates soon, they have a very low incentive to communicate that they are thinking anything dovish. They have to kill the investor psychology about inflation. So I would fully expect the Fed to come out today super hawkish, both in the statement as well as in the post-press conference commentary from Chairman Powell, not necessarily because they really need to be as hawkish as they want to, as they're saying they will be, but they really have to capture this consumer and firm and investor psychology and really make folks be thinking that the Fed's going to remain hawkish. So anyway, just think about the psychology of what Chairman Powell says today. All models are wrong. Some models are useful, but it should be an interesting press conference regardless. Probably a lot of volatility, both up and down, but don't expect a dovish Fed anytime soon, even if we do see interest rate cuts in 2024.